Good morning, ladies and gentlemen. Welcome to Ryanair's full year results investor presentation. As you'll have seen this morning on the Ryanair.com website, we've reported a full year profit after tax of €1.61 billion compared to a prior year profit after tax of €1.92 billion, principally due to traffic growth of 9% to a record 200 million passengers, but at 7% lower fares. The highlight for the last 12 months is notably traffic has grown 9% to a record 200 million passengers. Despite repeated Boeing delivery delays, Ryanair has become the first passenger airline to carry 200 million international passengers in 1 year. Average fares fell by 7%, and ancillary revenue has held up well, up 1%. Cost per passenger over the year has been flat as the cost gap has widened materially over competitor EU airlines. As at the end of April, we had 181 B737 game changers in our 618 aircraft fleet. We've launched over 160 new routes for summer 25. Over the last year, we've bought back and cancelled over 7% of our issued share capital. And we've reported a final dividend of 22.7 cents per share, which will be payable in September, subject to AGM approval. Turning to some detail on this, I won't dwell or spend a lot of time on it. I think the key feature of last year's results was the 7% decline in airfares, but this drove strong traffic growth of 9% to just over 200 million passengers. Operating costs, our key metric, were in line with our expectations. They rose 9% to 12.4 billion as fuel hedge savings offset higher staff and other costs due in part to the Boeing delivery delays. However, the key metric, which was operating costs, were flat on a per passenger basis. Our FY26 fuel is almost 85% hedged at $76 per barrel, a 4% saving on the $79 per barrel average cost in FY25. And I'm pleased to say we've also moved on recent weakness in the oil markets to hedge 36% of our FY27 oil needs at just under $66 per barrel, which would be a 13% saving on our FY26 hedge rate. We think this hedging and this aggressive hedging helps to de-risk our group from fuel price volatility over the next 12 months. Our balance sheet remains one of the strongest in the industry. We have a BBB plus credit rating. At the 31st of March, the year end, our gross cash balance was almost 4 billion, but this was somewhat artificially boosted by delayed aircraft capex into FY26. Year end net cash was 1.3 billion. As you know, we're preparing to repay almost 2.1 billion of maturing bonds over the next 12 months from our own internal cash resources. And I think that's a key strength of Ryanair. We're paying down debt to effectively zero over the next 2 years, while most of our competitors remain exposed to expensive long-term financing and rising aircraft lease costs. Turning briefly to the fleet, as I said, we now have 181 737-8200 game changers in our 618 aircraft fleet. We took delivery of 5 new aircraft from Boeing during the month of April. This will restrict our FY26 growth to just 3%. We expect to carry about 206 million passengers. We're confident, however, that the remaining 29 game changers in our 210 aircraft order book will deliver well ahead of summer 26, and this will enable us to catch up with delayed traffic growth into FY27. Boeing still expects the MAX 10 aircraft to be certified in late 2025, and so we continue to plan for the timely delivery of our first 15 MAX 10 aircraft in the spring of 2027, with 300 more of these aircraft, which, remember, offer us 20% more seats but burn 20% less fuel, due for delivery to us by March 2034. We expect European short-haul capacity will remain heavily constrained for the next few years, certainly out to 2030, as many of Europe's Airbus operators are still working through Pratt & Whitney engine repairs. The two big aircraft manufacturers, Airbus and Boeing, are way behind on aircraft deliveries, and EU airline consolidation continues. These capacity constraints, combined with our very substantial and widening cost advantage, our strong balance sheet, our low-cost aircraft orders, and our industry-leading operational resilience will, we believe, facilitate Ryanair's controlled, profitable growth to 300 million passengers per annum by FY34. I want to touch briefly on the ownership and control issue. As you'll be aware, we carried out a review of our O&C restrictions in a manner that continues to ensure our compliance with EU regulations. Following very positive feedback from both regulators and investors, the board resolved in March that it was in the best interests of Ryanair and our shareholders as a whole to discontinue the prohibition on non-EU nationals acquiring ordinary shares with immediate effect. We do continue to apply voting restrictions on non-EU nationals. Consequently, both EU and non-EU nationals are now free to invest in Ryanair Holdings plc via ordinary shares listed on Euronext Dublin or ADRs and Nasdaq. And we want to acknowledge that these changes have encouraged MSCI as recently as this week to confirm that Ryanair will now be included in the MSCI World Index at the end of May, an index inclusion we very much welcome. I just want to mention briefly Howard Miller. Howard has chosen not to seek re-election at the upcoming AGM when he will have served 9 years as a non-executive director of the board of Ryanair. Howard served as CEO from 1992, as CFO rather, from 1992 to 2014, a period of 22 years, and as an NED for the last 9 years. And I think you couldn't understate his contribution over that period of time. Without Howard, Michael, and the contribution they've made since Ryanair first joined the stock market in 1997, Ryanair would not be where it is today. And so I want to personally thank Howard and Michael for that contribution. Turning to outlook, we expect FY26 traffic to grow by just 3% to 206 million passengers due to delayed Boeing deliveries. Following a successful year of flat unit costs, we do expect very modest unit cost inflation in FY26 as the delivery of more game changers, strong jet fuel hedging and cost control across our group airlines help to offset increased route and ATC charges and higher enviro costs. To date, summer 25 demand is strong, with peak fares trending moderately ahead of prior year. Q1 fares will benefit from having the full Easter holiday in the month of April. In the prior year, only half of Easter was in April, and therefore a very weak prior year comps. And so the Q1 fares are on track to finish in mid-high teen % ahead of Q1 FY 2025. The Q1 results as a result will be very strong. With limited visibility, we're currently expecting Q2 pricing to recover some, but not all, of the 7% decline we experienced in prior year Q2. The final half-one outcome is, however, heavily dependent on close-in bookings and peak summer yields as we move through the months of June, July, August and September. And as is normal at this time of the year, we have zero H2 visibility. Therefore, while we cautiously expect to recover most, but not all, of last year's 7% fare decline, this should lead to a reasonable net profit growth in FY26. It's still far too early, however, to provide any meaningful guidance. The final FY26 outcome remains heavily exposed to adverse external developments, including, as we've recently seen, the risk of tariff wars, the impact of that on macroeconomic shocks, oil prices, conflict escalation in Ukraine and the Middle East, and, of course, European ATC mismanagement and short staffing during the peak summer season. And with that, I'm going to hand over to Neil Sorhan, our CFO. Neil, for any comments, and then we go to Q&A.
Michael, thank you very much, and good morning, everybody. Welcome to our full year results presentation. Ryanair is the lowest fare, lowest cost EU airline. The key advantage we have is our cost gap between everybody else, and that is widening and will continue to widen over coming years. We're number one for traffic and will grow to 206 million passengers in the coming year, FY26. We saw a record increase in our customer satisfaction scores last year to 86%. As we continue to deliver on-time performance and reliability for our customers and for our teams. Our 300 MAX 10 order book will underpin a decade of growth, and this, coupled with our financial strength and low costs, we believe makes us the long-term winner. Just a snapshot of where we are at the moment, 93 bases, 618 aircraft this summer, which will facilitate the growth to 206 million passengers in the coming financial year. We've 330 aircraft on order, and that will allow for profitable growth to 300 million passengers between now and FY34. Key slide, as always, in the deck. As you can see, the cost advantage that we enjoy over our competitors is only getting better. That cost gap is widening. You can see the advantage on such lines as the interest income line, where we're reporting interest income. Our competitors are reporting interest expense, airports, route charges, etc. We're beating everybody else. On the results themselves, we saw a 9% increase in traffic to just over 200 million passengers, becoming, as Michael already said, the first European airline ever to carry in excess of 200 million passengers. Load factors remained flat at 94%. The growth was stimulated by 7% 7% lower fares at €46 per passenger. And that, coupled with a solid performance in ancillaries, meant that we saw a 4% increase in revenue to just over 13.95 billion. Costs, as expected, rose in line with traffic, up 9% to 12.39 billion. And we reported a profit this morning of just over 1.61 billion, while at the upper end of our guidance range of 1.55 billion to 1.61 billion is still 16% down on last year. Our balance sheet is rock solid, a fortress balance sheet. We finished the year with just under 4 billion in gross cash, 1.3 billion in net cash. While that was somewhat flattered by the timing of CapEx into FY26, it still was a very strong performance after spending 1.6 billion on capital expenditure and returning 1.9 billion to our shareholders, including a 1.5 billion share buyback over the course of the past financial year. With that, I'm going to hand over to Michael to take us through current developments.
Thanks, Neil. So, as I said, we're the first EU airline to carry 200 million guests in 1 year. We are seeing slower FY26 growth, traffic up 3% to 206 million, due entirely to Boeing delivery delays, but the Boeing delays are improving. We are seeing robust summer 25 demand across the network. Forward bookings are strong. Pricing is above last year, but not sure yet whether we'll recover. We do expect to recover some, but probably not all of last year's 7% fare decline. We are operating in a marketplace in Europe with constrained capacity, and therefore we're engaged in to some degree of churn of our own capacity. We're allocating new aircraft and growth to those regions and airports who are cutting taxes and incentivizing growth. Fuel hedges, I think, are going to be a major story for our sector for the next 12 months. We were 78% hedged in FY25 at $79 a barrel. We're now 84% hedged into FY26 at $76 a barrel. And we've taken advantage of recent weaknesses in forward rates to hedge 36% of FY27 at just $66 a barrel. We're pleased this morning to announce a follow-on 750 million share buyback. We expect that will start from May 2025 and will run for up to 12 months. And I think the recent board decision to relax the ownership restrictions, which now means that EU and non-EU nationals can buy both Ryanair ordinaries and ADRs, and has paved the way for inclusion in the MSCI World Index at the end of May, is a very notable development. On Boeing, the situation is getting better. This summer we'll have 618 737s in the fleet, including 181 737-8200 MAX game-changer aircraft. We have been working with Boeing to accelerate the remaining 29 game-changers for summer 26. We will take a significant number of those aircraft before the end of calendar 2025, so that we have them in place and we can plan with certainty for summer 26. I'm pleased to say, thanks to the work that Kelly Ortenberg, Stephanie Pope and their team are doing, the quality and the timeliness of recent deliveries continues to improve. We got all 5 aircraft in that were due in April, either arrived on time or early. Boeing still expect the MAX 10 certification to take place in late 2025, and so we're still planning for our first 15 MAX 10s to arrive in the spring of 2027. And that would be a very exciting development. It'll be the first of 300 MAX 10 aircraft we expect to take up to March 2034. And those aircraft have 20% more seats, they burn 20% less fuel, and they will transform Ryanair's cost advantage and leadership over every other airline in Europe. We've set out here how we now see the orders will roll in. And as you can see, reasonably controlled growth to 300 million passengers by FY34. So as Neil alluded to, we have strong shareholder returns. We bought back and cancelled 77 million in FY25 at an average price of just over 19 euros per share. That brings to 36% the issued share capital that we bought back and cancelled since 2008. We paid a 400 million dividend in 2024. There's a 480 million dividend likely to be paid in 2025, subject to AGM approval. The follow-on 750 million share buyback starts in May 2025. We're able to fund this because of the Boeing delivery delays, which means our short-term cash has been boosted. And now I'll hand back to Neil for the 2026 outlook. Neil.
Thank you, Michael. Well, just based on what we know at this point in time, we've 618 aircraft in the fleet, so that'll enable us to grow now by 3% to 206 million passengers, in line with what we guided back with the Q3s, but still slower than we would have hoped prior to then. We're seeing strong summer demand, as Michael has already said, all across our network. Q1, which benefits from a full Easter in April just gone, and from weak prior year comps, is going to be a solid quarter for the group. We still don't have huge visibility into Q2 at this point in time, so it'll all hinge on the close-in fares and bookings for the all-important Q2. But we would be, at this stage, cautiously expecting that we'll recover most, if not all, and I emphasise not all, of the 7% fare decline that we saw in the prior year, FY25. This, of course, depends on whether there's any economic downturns into the second half of the year and beyond due to tariffs or other macroeconomic shocks. We're not seeing them at the moment, but you can't rule them out, and that could have an adverse impact on demand and fares into the second half of the year. We're only guiding modest unit cost inflation this year. We've good cost control across the business. Our swaps are locked in at attractive levels, but we are seeing double-digit increases in rates for route charges and ATC. We're also into the first year now of no ETS allowances, and we're into the first year of the SAF blend mandates. So we would expect to see modest unit cost inflation over the course of the next 12 months. So looking at all of that, what does it mean? We would expect to see reasonable profit growth over the course of the next year. It's just too early, however, to put numbers on it at this point in time. This, of course, depends on, as I said, no adverse shocks in the system. And then when you look beyond that, we've got the lowest cost of any airline in Europe. The cost gap between us and everybody else is widening. We've got a fortress balance sheet. We're returning funds to our shareholders, and we've got a low-cost order book, which is going to enable Ryanair to grow profitably, we believe, to 300 million passengers over the next 10 years. Thank you.